Good morning, everybody. Welcome to the second installment in our Women and Retirement webinar series. It's being presented by my partner, Tara Kendrick. We appreciate everybody joining us today. The topic we're going to hit today is one of those, what I call icky topics. In our practice, we've been helping people with retirement, tax, long-term care, and estate planning for almost 20 years. And amazingly, this is one of those topics that everybody's a little bit shy about talking about because it means that we're getting older and maybe our brains or our bodies are wearing out. And unfortunately, in all the research and analysis and helping that Tara and I have done, we found that this is probably the biggest financial risk that everybody's going to face as we get older. People worried about guys like Bernie Madoff. I do worry about stock market corrections. We worry about overspending, outliving our money. But this is one source, one problem that can very quickly wipe out your nest egg. So today we want to talk about solutions for that. And with that, I'm going to introduce my business partner, Tara Kendrick. Tara, take it away.
All right. Thanks, Bill. Good morning, everybody. Just some quick housekeeping. If you do have any questions along the way or at the end, there is a talk bubble at the top of your screen. You can just type in, it's like a little chat bubble, type in your questions and we will get to those at the end. All right, so let's get started. So why as women do we need to think about long-term care? Well, these are probably not new statistics, but they're good to be looked at again. And the first one is that women live about 7 years longer than men. And that long life means that you'll increase the need for long-term care. And in an AARP study, they found that more than 70% of nursing home residents were women. And I tell you, this is very true. And if a man ever shows up to a nursing home, they are always the most popular person in that space because there are so many women residents. And that's because we live longer. The other thing that was not surprising, but it's just an eye-opener, is that there was a study done out of Harvard University that showed that in 2018, women comprised 74% of solo households age 80 and over. So those women could have been single, but probably are divorced or widowed. All right, so what is long-term care? Well, long-term care is just a time when you need help with services, whether it's short-term or long-term. You can't live independently or you need extra care to live independently to be able to perform just everyday activities. You can get long-term care or help with long-term care at home. There's adult daycare centers, or in a situation where you would move into a facility, whether that's assisted living, a memory care, or then skilled nursing if you need a higher level of care. So who needs long-term care? Well, excuse me, back one, make it back. All right. So there's several things that increase your risk of long-term care because we're all ultimately going to need it because we don't get any younger as we age. We only get older. Your age, obviously, the older you get, the higher risk you have of having needing long-term care. And there is another statistic that talks about 2/3 of people over the age of 65 will need long-term care at some point over their lifetime. So it's majority of us. Women tend to be higher risk than men because we live longer. Women as single people tend to need more care because, from a paid provider, because they don't have a spouse to help them with their care. Lifestyle, of course, if you have poor diet and exercise, you're probably going to be at a higher risk and need care earlier. And then also, health and family history can be a risk factor. So how much is all of this going to cost? Well, if you go on the Genworth website, and they provide long-term care insurance, they had a cost comparison, and you can sort it by the area you live in. So you put in your zip code, and then you can look out 10 years, 20 years, 30 years to see what the difference was. So this one is showing the Austin area, and I looked 20 years out. So, currently, let's say an assisted living facility is going to cost you around $4,250, and in 2040, it's going to jump close to $3,400. A semi-private room in a nursing home right now is running on average about $5,000 a month. And in the next 20 years, it'll go up to over $9,000. And a private room will go up to over $12,000. So long-term care, bottom line, is not getting cheaper. It's only getting more expensive. And the longer you live, the more it's going to cost. So what do we do? How do we pay for this long-term care? Well, we're going to talk about 6 different ways today to pay for long-term care, and not all of them will fit you particularly, but they are all options that are available to all of us as women and men. So we have Medicare. You can self-insure, VA aid and attendance for those that qualify, long-term care insurance. There's also other income products, and then the great safety net, Medicaid. So let's talk about Medicare. And I know this is a really busy slide. And if you want to have a good instruction video about Medicare and Medicare choices, you can go on our website at srctexas.com and go under resources. And those are all of our webinars that we've previously recorded. And you can look at the full explanation about Medicare options. But just for this conversation, Medicare is short-term, long-term care. So when you turn 65, you get Part A and Part B. Part A covers hospital and nursing home. And when that says nursing home, that's the short-term, long-term care. That's 20 days after you've spent 3 nights in a hospital. You get 20 days of coverage for like rehab or short-term care in a skilled facility. And then after you get A and B, you'll want to get a supplement plan. And if you get a supplement plan, it'll cover your short-term, long-term care from day 21 to day 100. So the max amount of days of long-term care that will be covered by Medicare will be about 100 days. And then, of course, if you've got a supplement plan, you need a Part D plan. Or on the right side, you have Advantage Medicare Advantage plans, and that's more of a privatized version of the supplement and drug plan. So you have your A and B, and then you get your Advantage plan. The downside to Advantage plans is there's usually a copay on the 21st day. So Medicare will still pay for the first 20 days, and then your Advantage plan will pay up to 100 days, but they'll have a copay of what we've seen roughly around $175 a day. So it really is a lot of out-of-pocket expense. But that's kind of your start to long-term care, where you do have some coverage days up to 100 days. But it is short term. The next option for paying for long-term care is to self-insure. So that money can come from, pensions or Social Security that you get from your retirement. You can start, if you have a big nest egg and you've saved a lot because you knew that long-term care was coming in your future, you can dig into your retirement savings. There are life insurance products that will allow you to accelerate benefits to pay for long-term care. Another option is to downsize or sell your house. A lot of us are sitting on, $400,000, $500,000 homes. And maybe, if you need money to pay for care, you move into a garden home or a condo or an apartment or a smaller home, and you take that money to pay for your care. And then also annuities. If you have an annuity and you are getting income from that annuity, sometimes the annuities have an option that will pay double what they're paying monthly if you need long-term care for a fixed amount of time. So these are all ways that you can self-insure. The next one is aid and attendance. And I know this doesn't fit for everyone, but if you were a veteran or a spouse of a veteran that served during a wartime period, you are eligible for this benefit. So it's a non-service connected disability benefit, meaning you have to be over the age of 65 and unemployable. That is the quote unquote disability according to the VA. You have to have had honorable discharge, served at least 90 consecutive days of active duty, and have one of those days during a period of conflict. So I'll show you the next slide. On the left-hand side are the days, the conflict periods, and you can see there's World War II, Korea, Vietnam, and the Gulf War. So all you have to have is just one of those days within that range to be able to qualify in the 90 consecutive days that you served. Currently this year, aid and attendance, a married vet can get up to $2,200 a month to pay for long-term care, and then all the way down to the bottom, a surviving spouse in 2021 can receive $1,244. So, I mean, it's a good amount of money to help pay for whether you're at home, adult daycare, assisted living, skilled nursing. It really does make a difference and help you out with the cost of care. There is financial qualifications and criteria. The max amount of assets you can have is $130,000, 773. They do exempt your house if it's not on any land greater than 2 acres. Otherwise, they count it. You don't count your car, your final needs, or term life insurance. So that's your asset piece. And again, we have longer webinars on this, so we kind of take our time through all these pieces. I'm just kind of showing you what the short version is, but you're welcome to go on our webinars and take a look at the one on VA. Okay, so they do count your income, both married and single. So if you're a married vet and a spouse, they're going to use your combined income. So how much is your income combined is what they look at. Or if you're single, obviously, or a surviving spouse, just your gross income. And you have to spend more than you're making. I didn't put this in here, but you have to be spending equal to or more than what you're making on care in order to qualify. So if I have $5,000 in income combined, but I'm only paying $2,000 a month for someone to come in my house, I'm not going to qualify. But if I'm make $5,000 a month and I'm in an assisted living facility that costs $5,500, then I would qualify. So what can you do now? What can't you do? So you can't shield money anymore in an annuity or a trust. The VA does still count that, and you can't move money to another person. VA does have a look back of 3 years for gifting. And any gifts that you do have, they count it towards your total net worth. You have to send in bank statements. They check IRS records to verify your assets and income. But what you can do today, and this is what's real important in this part about VA, is you can, if you want to qualify now, you can use funds wisely. So how do you, let's say you have $140,000, you need to get it under $130,000. You could pay off a mortgage, buy a burial plan, get a new car, pay down your debts, or add more care costs. People who maybe need extra care, they can pay ahead or do something like that to get more care so that they qualify financially. The other part is to be proactive. Start thinking about it now. If there's gifting you need to do, there's a 3-year look back. Why don't we could do gifting today? So then 3 years when you need the care, you're eligible and it doesn't count. So this is just something to think about. And if you want more specifics or a slower version of this, you can go on our website and look at the VA webinar we've done before. All right. So the next piece is long-term care insurance. Now, this is insurance that is a great option, but you can't go and ask for it at age 84. We have had people come and call us and say, I'm 85 years old and I want to get long-term care insurance. Well, the long-term care insurance companies won't even take you at that age. The younger you are and the healthier you are, the better opportunity you have to get long-term care insurance at an affordable cost. because you buy it with your health, and that's real important. So you want to make sure you get it while you're young and while you're healthy. It'll pay anywhere you're receiving care, at home or in a facility. And you have to trigger it by needing help with 2 activities of daily living or have cognitive impairment, dementia, Alzheimer's, that sort of thing. They have individual policies, and they also have shared policies for couples. We strongly recommend getting a shared policy if you are a couple. You get a couple's discount, and you actually share in the amount of days and years that you can use it together. How do you pick a long-term care company? We always look at, what's their history of rate increases. If they're constantly increasing rates over time, maybe that's not the best company. And you're welcome to give us a call, and we can give you some options or quotes if this is something you're interested in. The other piece is that we have the Texas Partnership Plan, which basically doubles the value of your long-term care policy, meaning if you spend $200,000 in long-term care insurance coverage, then they will let you protect $200,000 of your assets if you continue to need care and you need to get on Medicaid. And most insurance plans now have the partnership as long as you have inflation protection. Okay, let's see. So how people always ask us, how much does it cost? Well, the problem is it's like asking how much does a car cost? Is it a Kia? Is it a Porsche? Is it a Lexus with all the bells and whistles, or is it the basic one? And so there's a lot of different triggers that change the cost of your plan. It can be, how long is the coverage going to be? How much is it going to pay per day? How the elimination period, is it going to be 90 days you have to pay out of pocket before it turns on, or 180 days, or 365 days? Do you have inflation protection? Do you want it to grow 1% every year? Or do you want it to grow at 3% every year, or 5%? And that will change how much it costs. And they also have some other riders you can add on. But the biggest thing is just to get a quote and then decide, hey, that's too much. Okay, we'll take a 6-year policy, maybe move it down to 4 years or 3 years. So these are all different things that we can do for you if this is something you're interested in, and we can get you a quote. Now, people always ask us, why should I get long-term insurance? Why should I not? The pro for long-term care insurance is that, you can feel good that your long-term care is going to be paid for wherever you need care for that specific amount of time. The downside is it can be expensive per month, and you are paying on it for life. And if you don't use it, you lose it. So you can put a lot of money in and then die in your sleep, and you're not going to get it back. So that's the risk you kind of take on getting it. But some people feel very good because they want the confidence to know that their long-term care will be paid for. All right. The next part is insurance products. So there's other insurance products out there than just these 3, but we just wanted to highlight these 3. So there's life insurance, there's asset multiplying products, and then there's annuities. So we'll go through each of these. So on your left, you'll see your asset multiplying product. So this one is, let's say you have a lump sum of money you'd like to invest. Instead of, paying a monthly fee for long-term care insurance, you're just like, I have $100,000. I'm going to fund this asset multiplying product. And what will happen is that long-term care product it'll double 1.5 times on day one. So the first $100,000 that pays out is your money, but the next $150,000 paying out to your long-term care is on the insurance company. The nice thing about this product is if you never use it, unlike long-term care insurance, the money will go to your beneficiaries. So it's like doubling your money to help protect yourself from long-term care expenses, because the insurance company is going to pay 1.5 times what you put in. The next opportunity is annuities with income doublers, and we're big proponents of income in retirement. It is so important to have income in retirement because you can feel good that no matter what happens with the stock market, what's happening in the world, that you're going to be able to live comfortably. And so let's say you have your money in an annuity and you're getting an income stream and you need long-term care. Well, in that instance, there are a lot of products that will double the amount of money paid out over a fixed number of years to pay for long-term care. So let's say my annuity is paying me $1,000 a month, and then suddenly I need in-home care. I can turn on the doubling effect, and now I'm going to get $2,000 a month for a fixed amount of time to help cover my costs. And then the last one is life insurance. And this is a really good option for people who, have extra money that they want to put in. It's twofold. So you're going to have a great death benefit, but if you need long-term care, you can accelerate the death benefit and be able to withdraw a percentage out every month to pay for that care. And the nice thing about those withdrawals is they are tax-free. So it is not going to be considered income tax, and that'll help pay for your care. And then whatever's left in the account at the end of your life will also go to your heirs. So again, it's not a use it or lose it situation. So those are your insurance products. Okay, so the last one is Medicaid. And I know a lot of people think, oh, Medicaid, that sounds like horrible care. That sounds like the worst, or, oh, I have to be broke. But we consider this a valuable resource in the U.S. for people who are aging. And we like to call it the great safety net. Now, the one difference with Medicaid versus all the other options that we've talked about is it only pays in skilled nursing homes. So this is going to be your highest level of care. And there are eligibility requirements. Obviously, you must be in the Medicaid bed, so they must have a space for you that pays for Medicaid at a facility. You have to meet medical necessity, so need help with 2 activities of daily living or cognitive impairment. And then there's income and asset criteria that you have to meet. But never will you have to have income that's too high to not qualify. And then assets, our job and what is super important to us is protecting assets. So there's 2 rules that we always tell people is that a couple can protect everything they have and get one spouse on Medicaid. And then a single person can protect a house, a car, a burial program, and about 50 to 60% of their assets if they do it right. But a lot of people don't believe that. They believe in these myths, these Medicaid myths. So the first one is, like I was saying, you must be broke, but couples can protect everything they have if they do it wisely. And it's so important to speak to someone like us or someone who's in the industry to help protect those assets. Single people, again, house, car, burial program, and about 50 to 60% of their assets. And then the newest thing within the last 5 years is that if anyone has retirement funds, single or married, and they're held inside an annuity, whether it's a variable or a fixed annuity, they are exempt from spend down. So if I have $25,000 in the bank, but I have $300,000 in a, say, 401k, 4 or 5 years ago, all of that would have counted towards my eligibility for Medicaid. But today, if I move that $300,000 into an annuity, it's completely off the table based on the state. And all they're going to look at is that $50,000. And then, of course, you come to see us and we'll protect that money as well, along with the $300,000. So that's real important because a lot of people think that they have to get down to 2 before they can before they can even try to file for Medicaid. And that's not true. The other one is my income's too high. And income will never stop you from getting on Medicaid. There is a threshold. If your income's above $23.82 in 2021, you have to get what's called a special trust or a qualified income trust in order to qualify. And that's just a legal document you take to the bank and you open up a special qualified income trust account that you have to funnel your money through. And that's a way for the state to be able to control how the money is spent. So it's just an added step, but income will never prevent you from getting on Medicaid. All right, a couple other myths are My quality of care is poor. And I think a lot of people get real scared because they remember 20, 30 years ago their aunt or their grandmother being in a facility and how horrible it was, and it was a Medicaid facility. And today, I would say 95% of all nursing homes in the state of Texas take Medicaid, whether it's the new shiny one that just opened with the famous chef in the kitchen, they will take Medicaid. And there is nowhere in that facility that says this is a Medicaid wing, this is a private pay wing, because there have been a lot of lawsuits over time for discrimination. And so they cannot discriminate. So probably the only person in that whole facility that knows how they're paying is the business manager that runs the books. So the quality of care is not based on the facility. We always tell people it's based on the number of visits from the family, because the more often you go, the more the staff is going to know that you're around and that you're paying attention to what they're doing, and they're going to care for your family member better. So that's where we always say, pick a facility that's close to the home of someone who's going to visit often. All right. People have come in and said, oh, well, I gifted all my money to my daughter, and so now I'm not eligible for Medicaid. And that is a bad, bad, bad idea. You can do gifting if you do it correctly, and that's where it's real important to get some professional advice. But if you give away assets, there is a penalty, and the penalty can be, it just depends. If you give away $2,000, you're going to have a few days of penalty. But if you give away $200,000, you're talking 3 or 4 years of ineligibility. They do a calculation based on the amount of the gift. So you always want to make sure that you know what you're doing when you do gifting, but gifting will always create a penalty. And the last one is I'll lose my home. And this is also not true. When you apply for Medicaid, your home is exempt, your homestead. If you have other land, that will count, or other property, that will count. But your homestead will not count. Now, when you die, the state does come back for it. The Medicaid Estate Recovery Program will come back for whatever they have paid for your care in the sale of your home. But you can protect it with what people call a ladybird deed or a special warranty deed. And if you put that on before your death, then it will jump probate, which means that it will jump Medicaid estate recovery, because it says at the moment of my death, I give my home to blank. And so when the state says, what did you have at the moment of your death? The answer is nothing. You had nothing in possession, therefore they cannot take your house. So you will not lose your home. So those are the 6 ways to pay for long-term care. I have looked at countless websites in all different areas of finance and aging, and this is pretty consistent to what you'll see across the board of all the different types of options that you have. So educating yourself is really important. I'm so glad you guys are here today to learn about this and to kind of pre-plan. Now, when do you start planning? And I say now. Now is a great time to start thinking about this. So in your 50s, this is a good time to investigate long-term care insurance if that's something you want to do. You're healthy, you're young, the cost will be low. In your 60s, you probably could still investigate long-term care insurance. When you turn 65, real important to make sure you get the right Medicare options. And we help with Medicare planning, so call us on that. Then let's look at income planning. Income planning is really important. We are big proponents of making sure that you have enough income in retirement. So we can take a look at your investments and what you have in assets and see how we can create income for you in the future. So that's really important to do in your 60s. You can also look into insurance options that we talked about, and then ways to protect your assets now so that in the future they're protected when you need long-term care. And then in your 70s to your 90s, this is probably when you'll start needing long-term care. So that's when you'll investigate pre-planning for VA benefits, again, protecting your assets, and then when you need it, Medicaid. All right. So something else I wanted to bring up before we close that's real important that we see time and time again when we help people with long-term care planning and long-term care for families who are needing Medicaid or VA is just to have your financial house in order. So making sure that you have powers of attorney, both financial and medical, for yourself, for your spouse. Something to consider is having an advance directive. What are your wishes at your end of your life? That's important to share with your family. Putting beneficiary designations on all of your assets. If you do this, you won't have to go through probate. So your bank accounts, your life insurance, your investments, make sure that you have beneficiary designations on there. So if you die, they go to the people you want it to go to. And then start having a conversation with your family about what your long-term care plan is. Where do you want to end up? Do you want to have, help at home for as long as you possibly can? Would you prefer to live in an assisted living facility because you don't have to worry about a house and you want to have friends around you? These are things you need to tell your family. And then lastly is, I think very important, is to document all of your assets, your insurance policies, and then make sure you make up that list, write it down, send an email, have a file that they know where it is in advance. This is not a time to hide things. I know people tend to, keep things close to the vest and don't want to tell their family members about their money or their situation, but it becomes really painful if you had a stroke or an accident or an illness that caused you to not be able to speak for yourself. And now the family is having to dig through drawers and files and call people. And it's just a big headache that you can relieve them of if you go ahead and just tell them, here's where my stuff is, whether it's in a lockbox at the bank, wherever, so that they know if something happened to you, that they would know where to access it so they could help you. So I think that's about it for us. Now, I really appreciate you listening to me. And if you have questions, I would love for you to pop them up there in the chat box. And Bill's going to chime in for any other questions that we have.
Terry, you covered an awful lot of ground. This is a very important topic, but as you can see, there's a lot of different options on trying to address it. And each one of those options raises questions. There's pros and cons to everything that Tara and I do. And one of our jobs is to educate and to kind of say, hey, here's the pros and cons of this versus that. What's the best fit for your specific situation? So, Terry, you want to see if we've got any questions?
Sure. Let me see. Here's one. So if I have some questions about creating a long-term plan, how much does it cost?
That's a real good question. Tara and I are kind of fee adverse. Many of the strategies that we talked about today, using annuities to create income that doubles, or life insurance where you can tap the death benefit, or asset multiplying products, or using Medicare for short term. We don't charge for those. We do charge if we take on a family's case where it's going to be applying for VA and or Medicaid benefits. And we're kind of unique in this area. We charge a single fee. It covers, if you're married, it covers both spouses and it covers both programs, both VA and Medicaid. Our fee is $3,000. And for that, we generate a written plan that maps out how we're going to get to VA and or to Medicaid in the future. And many times, we start out with a couple, one of the spouses needs care at home, so we go for VA. But eventually they evolve to a point where they need to go to a nursing home. And at that point, we switch off and file and qualify for Medicaid. And going back to something Tara said, throughout all these different options, there's one underlying theme, and that's asset preservation. Our practice started with Medicaid back in 2002, and the goal then and now is preserve assets. We don't want one spouse causing a couple to spend down all of their savings to pay for care, only to run out of money and then go to heaven and leave the other spouse living under the Congress Street Bridge with nothing left to spend. So we charge a single fee, covers both spouses, covers both programs, and we make it guaranteed to all of our families. if for some reason, this has never happened, but if for some reason we're not able to get to Medicaid or to VA, we refund our fees. We want this to be a win-win with all the clients that we work with, that they get a benefit and obviously we get paid for providing a service. That said, our practice is not just long-term care. It's retirement planning, tax planning, estate planning. We work in many different areas.
And our consultations are always free. So you're always welcome to come in. We can talk about your situation. If we can help you, wonderful. If we can't, that's okay too. Or you can give us a call. You can send us an email. Our email is up there on the PowerPoint, and we're happy to help in any way we can. We want to be a resource to you and to the community. So,
Tara, I see there's another question coming
Sure.
in. Let's see. It's a question regarding spousal benefits under VA. Why don't you explain what it takes to get spousal benefits? It's tied to your most recent spouse.
Oh, yes. So with this, and I didn't touch on this, and again, you can go back and watch the VA benefit, but for the spousal benefits, just remember it is your most recent spouse. So if you were married to a vet and then divorced and you're single, you can't get VA benefits. Or if you were married to a vet and divorced and now you married someone else who's not a vet, you cannot get benefits. But if you married another vet, then of course you can. And if you die, if the marriage ended in death with your veteran, then yes, you are eligible for spousal benefits.
Good. Let's see. Any more questions? I think that's it for today. What's our topic for next week?
That's a great question. I do know it, but I just lost it.
Okay,
Anyway.
well, we're gonna wrap up today. We really appreciate everybody standing by for joining us today. We're gonna send you two things: a link to a recorded version of this webinar so you can replay it. I know Tara covered a lot of different topics, a lot of details, and it's kind of like drinking out of a fire hose. So we're gonna send you that. We're also gonna send you a copy of the book that I wrote during the pandemic on more money for retirement. And it covers all the other topics that Tara and I help people with, whether it's Social Security, Medicare, avoiding probate, creating safe, secure retirement plans, avoiding market corrections, all the things that we do every day in our practice. The book's about a 1-hour read, but if you read it, you'll understand the various ways we help many families, and it'll give you a sense for how our philosophy in creating safety and security in retirement. So we're going to have another webinar next Tuesday, 10 o'clock, same time, same place. We invite everybody to join us, and we'll send out an email with the topic. And until then, have a great week.
All right. Bye-bye. Thanks, everybody.